Welcome to the Rolling Trades podcast this week. My name's Tyler Herrmann, Senior Market Strategist at RJO Futures. But today we're going to be looking at corn and soybean markets as well as the quarterly USDA report for next Monday, June 30th. First of all, getting into a couple new things this year with options on the grains. We saw front month contracts starting in July move to 1 cent strikes in corn and 2 cents for beans. Is this going to make a huge difference in the strategies that you employ? Probably not. But one thing I did notice that was interesting for the July contracts is that moving that strike a couple cents sometimes was able to get you a little bit better of a premium, depending on how you wanted to work that into your strategy. The next thing that's been new for this year is the weekly option expiration. Typically, that was every Friday. Now you can choose what day you want that to expire, Monday through Friday. I think this is going to be beneficial for those midweek reports where you want coverage through that report, but don't necessarily need or want to pay for the added premium to the end of the week there. So let's get into the grain markets a little bit here. Seasonally, we see the grain markets post their highs of the year in the June to July time frame there, with the second most common being April, May. Obviously, June and July, we see weather issues come. April, May, any planting disruptions or slowing of the pace there being another driver of the market higher. November and December is typically when lows are placed after the grain's been harvested and the supply floods the market. Really, some events at the start of the year that could potentially have caused a rally were low soil moisture in the Western Corn Belt, major cyclical drought predictions, forecast of a wetter than average April, tight ending stocks in old crop supply, as well as estimates of large planted acres numbers and yield for new crop here. One thing to remember, though, is we've seen a lot of market disruptions with tariffs and escalations of global tensions throughout the world that could make this far from a normal marketing year as far as the seasonal trends go. Looking at a couple of things as far as old crop ending stocks, we saw with, first of all, the July-December corn spread, that the market really discounted any tightness in the old crop supply. Seems like the end users procured their needs for the next couple months until this large new crop supply kind of floods the market. We saw a sell-off from kind of end of April to May from over 30 cents in that spread down to a negative 13, 14 where it's at currently. Similar thing with the soybean July Nove calendar spread. I mean, other than a little bit of an uptick in June, pretty much saw a pretty big sell-off there, showing that the market wasn't really concerned about old crop tightness in supply. So really, we checked a lot of the catalyst off of our list for what could push this market higher, leaving only a reduction in planted acres that we could potentially get on Monday, a reduction of yield estimates, which we're really not going to see a set number from the USDA until later on in the year, August or September timeframe on those, or any damaging weather, above normal heat, severe drought conditions, and or storm damage. Not necessarily something anybody wants to root for to drive the price higher here. So let's get into the grain stocks as far as what is going to be discussed next Monday. Looking back at the June WASDE report, pretty uneventful. The only real change that we saw was a 50 million bushel revision higher in the export number on corn to try to keep pace with those export numbers that we've been seeing week to week. No major changes in the soybean market. One thing that we could see here wasn't made in the June report, but a potential revision in the USDA's feed and residual usage number. Right now, the usage is far below their 5.75 billion bushel estimate. And I think mainly that was from waiting to see what the numbers were going to be from this June 30th report. We also had the cattle on feed report come out last Friday, which showed a little bit of reduced numbers. And then tomorrow, Thursday of this week, we are going to see the quarterly hog and pig report that is estimating a slight reduction as well. As mentioned, as far as corn ethanol, exports remain strong for the March to May timeframe, being the highest in 4 years and the second highest on record. Ethanol usage is continuing to come in slightly lower than estimates, so not a whole lot of changes as far as the corn stocks, except for that potential the potential change that we could see coming from the July 11th WASDE report. Looking at the soybean market, third quarter export demand was pretty solid as well, mainly from a strong crush demand, which was fueled by a soybean oil rally with the announcement of a biofuel blending mandate increase. So let's move on to the June 1 corn stocks here. RGO is estimating U.S. corn stocks at 4.681 billion bushels, which is a little below last year, but still above the 2021 to 22-23 average of 4.188 billion bushels. Looking at soybean stocks here, again, RGO estimates stocks at 967 million bushels, pretty much right in line with the 970 million bushel estimate from the USDA. Although the stocks to use number is down slightly from last year, it's still the second highest in the last 5 years. So moving on to the acreage report here, we were able to make it through planting without any major widespread issues for corn and soybeans. And in fact, we reached the 75% completed date, well ahead of the 5-year average pace. Looking at the March Perspective Plantings report, the total 2025 planted acres number was to be 248 million, slightly lower than the previous and the lowest planted acres in the last 5 years. This not only includes corn, soybeans, wheat, but also oats, barley, canola, cotton as well. So pretty much combining everything together. But like I said, without any major planting issues this spring, we feel like there's potential for the corn and soybean planted acres to come in on the high side. Looking specifically at the U.S. corn planted acreage change, this chart here, or table here, shows the change from March to June as well as March to final acreage. And we see that the USDA has raised the planted acreage number for corn each of the last 4 years, last year by 1.4 million acres, and the previous year 2.1 million acres. Moving on to the soybean planted acreage change, we see that on opposite of corn, it has actually been lowered the last 3 years in June, with 2023 seeing adjustment of 4 million acres lower, which was, we saw the soybean planted acres, on the other hand, lowered in the past 3 years, with June 2023 seeing adjustment of 4 million acres. Looking at the June numbers compared to the market's average estimates, corn acres came in higher the past 2 years, with soybeans coming in lower than expected for the past 6 years in a row here. Like I said before, RGO estimates that both of these coming in on the high end on Monday, with corn at 95.6 million acres, with the March estimate being 95.325, and soybeans at 83.8 million acres versus the March estimate of 83.495 million acres. Moving on to the balance sheet here. The USDA doesn't give us updated balance sheets on Monday's quarterly report, so we'll have to wait to get a glimpse of those on the July 11th WASDE. We also won't get the first estimate on the corn and soybean crops until the August WASDE, which is solely based on farmer surveys and satellite images, not really getting into the field-based assessments until the September WASDE report. So one thing to remember when trading these markets, the doesn't really matter what you think or what is localized in your area. We really got to work with the numbers that we're given, and we're not going to see major changes in those until later on this year. Couple things though to really pull out on the corn supply and demand balance sheet here that we got in June. We see the yield number 181 bushels, which is well above last year, and then even the highs from 23, 24, and 21, 22. So with a large acreage number here, I think we're going to need to see more than 2 or 3 bushel reduction here to really cause a rally. We're probably going to have to get more so in that 176 to 177 number to get any sort of extended rally here in the next few months. Moving on to soybean market here. Again, USDA is calling for 52.5 for a yield number, which isn't as inflated as the corn side, but still, even a bushel or two here, reduction lower, shouldn't have that big of an effect. One thing to look for, though, is the acres number is well lower than last year and more in line with averages from previous years here. Next, just the trade estimate summary to use for Monday's report. Again, the range of estimates, we're kind of looking at the high side for corn and soybeans. Really, the big changes or the big market reactions come from surprises in this. So if we get anywhere outside of the range of estimates, or for example, on the ending stocks, the average estimate is calling for a reduction from last year. If we see a bigger reduction than expected or a gain, that's when we're really going to start seeing those big market swings. Getting into weather, really going to be the next big potential catalyst, like we mentioned, to cause any move higher here. But we continue to see favorable weather throughout a lot of the areas here. Some of the drier areas that we've seen last week, Nebraska, Iowa, South Dakota, is catching some rain or some precipitation in the near-term forecast, while the wetter areas, such as the southern parts of Indiana, Illinois, and Ohio, are getting a little heat, which is welcomed here for their crops. Again, looking at a little more longer time frame, nothing but favorable weather here, at least in the short term. Really, once we get out to the second or third week of July is going to be the real big driver for the corn market when pollination happens. Next, we're going to be looking at the August weather is really the determining factor on the bean market. But so far, everything continues to look well, and no major concerns as of yet. So let's look at a corn chart here. As we can see, the high of the year so far of 480 has been posted in February. We really were kind of holding strong at this 435 to 437 level until pushing below it here at the start of this week. Although we did see some crop progress, good to excellent ratings get knocked down a little bit. We did see announcements of a large Brazil and Argentina crop, as well as a heavy net short position from the funds, which continues to push that lower. Another thing to note here, although the funds do have a large net short position, it's well off of their record short, so we could continue to see some more piling on and pushing this market lower if we have continued fundamental news to continued bearish fundamental news as well. Really, what the bulls are looking for here is a retest of resistance around the 445 to 448 level, which is the start of that trend line that we've been bouncing off of, as well as the 200-day moving average as well. Moving on to the soybeans here, kind of the same thing. Unable to really trade higher than this 1080 high that we've tested a couple times back in February, and then again here recently in June, that recent push higher, the biofuel blending mandate that drove the soybean oil higher really pushed that as well. Kind of like the corn, we really want to look at that trend line, want to hold that and continue to push higher. But if we do break below that, looks like $10 is the next real level of support, and then 980 and 960 being those recent lows that we really want to stay away from. So let's start looking at some strategies for how we can capture some of these anticipated moves in the market that we're looking at. The first thing I like to do when looking at different strategies is try to define what we're trying to ultimately do. I like to do something that gives us options later on versus being forced to make a decision. We really benefit from having as many choices as possible. And I really like to ask or try to determine when putting these different strategies together, what's going to be the worst case scenario? Would we rather do something and potentially miss out on a little bit of upside, or do nothing, sit on our hands and have it continue to move against us? Again, these strategies that we are looking at are just examples. All of them are in the bean, or all of them are in the corn market. We can put these over to beans as well, but really the important thing is calling in, talking to me, and we can tailor this to your individual situation. Another benefit of why I like using option strategies is you really get to decide what's important to you, and we can flip other things around to fit that. If you want a certain price, a certain strike, a certain time frame, whatever one of those three is important, that's what we can focus on, and we can kind of rearrange everything else to make it work. So in looking at strategies to best capture these anticipated moves in the market, the first thing I like to do is really define what we're trying to do. I really think that doing something now and gives us the most options later on is the best case scenario, rather than being forced to make a decision down the road. Whenever you have more choices, it always seems to be better. One thing I really like to do in lining up my strategies is use the short-dated options. Right now I'm looking at the September timeframe, which gives us to the end of August. And really what that allows is to not have to pay the added premium to the November, December timeframe there. So thanks for joining us again on another episode, on this week's episode of the Rolling Trades podcast. Again, my name is Tyler Herrmann, Senior Market Strategist, RGO Futures. You can reach out to me at therrmann, HERRMANN, at rgofutures.com, or it can be reached at 312-373-5099. Thank you.
The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical tests of strategies, is not indicative of future results.